Good afternoon. 4:30 here in Cincinnati, and I apologize for being a little bit late. I experienced some technical difficulties. We're going to discuss the last two actual chapters in the book, and then next week we have three bonus chapters. We'll probably spend about an hour and a half tonight, maybe just a little bit longer, probably not the full amount of time we normally spend, talking about chapters 19. Using securities markets for financing and investment opportunities. Really carries on a little bit from chapter 18 last week. And then we'll turn to chapter 20, which discusses everyone's favorite subject, money, and then financial institutions and the Federal Reserve. So let us look at our learning objectives for chapter 19. Describe the role of securities markets and of investment bankers. Identify the stock exchanges where securities are traded. Compare the advantages and disadvantages of equity financing by issuing stock. Remember, we did a little bit of this last week. Pardon me. And detail the differences between common stock and preferred stock. Compare the advantages and disadvantages of obtaining debt financing by issuing bonds and identify the classes and features of bonds. Explain how to invest in securities markets and set investment objectives such as long-term growth, income, cash, and protection from inflation. Analyze opportunities stocks offer as investments. Analyze the opportunities that bonds offer as investments. Explain investment opportunities in mutual funds and exchange-traded funds, ETFs. And then describe how indicators like the Dow Jones Industrial Average affect the market. Now, one thing I want you to keep in mind as we go through this is that the Dow Jones Industrial Average is the most widely quoted stock market average, and it is most widely referred to and the most widely used. And the reason is because it can be easily calculated. It is, however, not the most accurate. The most accurate in the United States is the Standard & Poor's 500 index. I'll talk a little bit more about that later. So let's move into chapter 19 here. We're talking here about the basics of the security markets. So remember, a market, I don't know that we really discussed this early on in the course, and I should have, and if we didn't, it's my error, and I apologize for that. A market is where a buyer and a seller meet to make some type of a transaction. And they don't have to meet physically, face to face. They can do it by telephone, do it by internet, do it by fax, do it by any number of means in which they can communicate to effect a sale. Two primary functions of securities markets are to assist organizations in finding long-term financing and to provide us, the folks who are not in that type of market, or in a type of business as well as the market, an opportunity to buy and sell securities and make a profit, hopefully. Several types of securities to look at. They're primary security markets, not securities itself. Securities are separated into primary and secondary markets. The primary market is in the business of selling new securities, whereas the secondary market handles the trades, if you will, selling, buying, etc., between the investor, that would be, in this case, would be a person like me or like you, with the proceeds of the sale going to the seller. So if I wanted to sell stock, and I have to tell you that in my owning stocks and bonds and things of that nature, I have only sold stock once, and that was on behalf of my mother. Uh, and I happened to be the executive of her estate, and she has some stock, and she needed well, had her power of attorney at that time. She was still among the living, but she needed some cash because she was in a nursing home and had bills to pay, et cetera, et cetera. So it was better to take that stock that she had and to sell it and put it back into her savings account, so she would have that capital when she needed it. So I've only done that once, and had a very pleasant experience going through a brokerage firm that I've used for a number of years. Well, I happened to be talking on the phone with you. Actually, I tried to do it by the internet and couldn't. And while I was talking with one of the representatives on the phone, I told him, he said, well, we'll take care of it. He said, by the way, while we're talking, the stock just went up a couple of pennies, so I'll make the trade for you now. So my mother actually gained a little bit while I had a conversation on the phone. The last thing is something we hear quite often about, and people get all excited about them, initial public offerings. That's exactly what it says. It's the first time the stock in a company has been offered to the public. Now, we hear of a number of different types of players in the market, investment bankers. Notice what they do. They assist in the sale and issue of new securities. A company goes to them and says, look, we want to make an initial public offering, and we want you to help us handle this type of transaction. Institutional investors are exactly what it says. And they are large organizations. One of the largest in the United States is CalPERS. That's the California Personnel Retirement System. Now, California has another one, and I really don't know or don't remember the name of that. But CalPERS is very, very, very large. And when it decides to buy or sell something, it makes the market move very quickly. I don't know right off the bat what we are selling, trading, let me use that term, on a daily basis on the New York Stock Exchange. But I can remember many years ago when somebody would, a newscast I used to listen to at noon on the radio, would talk about that the stock market was doing this or that. They had a brisk 60 million shares sold. I was talking about days before the internet. And shares are sold in milliseconds today. And one of the problems and I do say it's a problem that we individual investors have, is that these large firms, like these large institutions like CalPERS and other organizations, have the ability to move the market in an instant because of buying or selling. So we don't have the ability as individuals to do that, and that's why many people decide not to go it on their own. They buy mutual funds, so they have the power of a number of people in doing things. These stock exchanges, most of us are familiar with the New York Stock Exchange, which will come up next. This is just a place to look at the stock exchange as a market. And this is the difference here, is that to be able to buy and sell stock on a stock exchange, you have to be a member of the stock exchange. You have to have what's known as a seat on the exchange, and you pay a certain amount of money for that. And so if you want to buy and sell stock, you have to go through a broker whose company, pardon me, has a seat on the exchange. there are a couple of different kinds of markets. We have the over-the-counter market. Those are often known as penny stocks. The American Stock Exchange, and I'm not really sure if it's still operating. If it is, I'm not sure. I don't keep up with that a whole lot. They were a couple of years ago, but I haven't paid much attention to them lately. But anyway, most of the shares that are there on those stock exchanges are not on one of the big exchanges. And doesn't mean to say they're not national. They're just not on national exchanges. The next one we come to, the NASDAQ, it focuses completely on electronic trading. And notice it has dealers across the country, but again, it's all electronic. There is no, I can talk to somebody on the floor of a stock exchange like you can in the New York Stock Exchange and have him or her execute a trade for me. Here are some other stock exchanges. NASDAQ's mentioned again. NYSE, New York Stock Exchange, Euronet. There was a merger between those two. London Stock Exchange, also known as the FTSE, FTSE, Financial Times Security Exchange, I believe is the correct term. Tokyo Stock Exchange, I don't remember their name. The Deutsche Börse, which is German. Now, this is just a small business that jump on funding. And you can see this displayed in your text as a sidelight on page 335 at the top. We're not going to make a lot of discussion about that because this is just a sidelight. I always suggest that you read these things because you can get some information from them, but it's not something that's actually part of the text, if you will, in a small way. Now, this is the Securities and Exchange Commission, and we're going to talk a little bit about that, the SEC, created in 1934. The first chair of the SEC was Joe Kennedy, father of President Kennedy and Senators Robert and Ted Kennedy, chosen by Franklin Roosevelt. They are the stock markets and other securities markets, not just the stock market, bond market, etc., and companies that trade on them, watchdog, if you will. They are a regulatory agency established by the United States Congress. One of the problems that the agency has, this particular agency, and many agencies in the federal government, as far as that goes, is there are usually too few regulators, and the agencies are not well funded. So we have a yin and a yang between what we went through with the Great Recession, which we are crawling out of, is my term. And the reason I use the term crawling is because I think that the recovery has been rather uneven. It has lifted, a number of people and a number of organizations to back to where they were before the recession hit, and actually exceeded. Other people and other institutions have not done as well, and that's why I use the term uneven recovery. One of the things that's mandated by the Securities and Exchange Act, which established the Securities and Exchange Commission, is that every company who wishes to sell stock or some type of other securities instrument has to provide a prospectus. And what this is, as it says here, it is a picture of the organization, the firm's health at a particular time. It gives its goals and objectives, et cetera, et cetera. And what it does say there, it's usually in fairly bold print you can read, that a prospectus is not a blueprint, if you will. They don't use that term for future gains. This is just what it's been, and history doesn't mean it's going to repeat itself. Everyone who is a potential investor who contacts a broker or goes through his or her mutual fund company or whatever it is and says, I'm interested in XYZ, has to be given a prospectus. Now, what we're going to do here is do a little primer on the language of stocks. A stock, if you own stock, actually it's a share of the company. It says that you are a part owner. Depending upon how many shares you have, you're either a big part owner or a small part owner. I mentioned earlier today to one of the folks in the class that my wife and I've owned the stock in the company for a number of years, and it's split a couple of times. But that means we have a fairly large number of shares, but regardless of the number of shares we have, we're still a very small stockholder in a very large company. A stock certificate is something that companies no longer issue. It just says the bearer owns X number of shares of stock. Some people have stock certificates. My wife and I have some. The company I'm talking about, I'm not going to mention it, but every share we buy now from that company is held for us electronically. I don't have shares of stock that I can hold up or certificate to say I own X number of shares, or my wife and I own X number of shares. A dividend is something that a company pays to its stock owners, but they're not required to do that. It either comes in the form of additional shares or in cash, or it comes in the way of your dividend. The company I was talking about, we get a quarterly dividend, and it says, you can do one of two things. You can either take your dividend and buy more shares of stock, or we'll send you the money. One company that we have stock in does not have that, where you're allowed to use your dividend to buy extra, so we get a check every quarter. The other one I'm talking about does do that, and so we take our dividend and roll it over into buying additional shares of stock. Now, that's not something that you have to do. It's something that you can do, and it's up to you to do that. If you want to buy additional shares, it certainly gives you more ownership. And if you want the money that comes along with it, it's fine. Now, one thing you remember, and it's the second bullet here, there is no requirement any place, anywhere that says a company has to pay a dividend. Some companies don't pay dividends. They take their earnings and plow it back into the company. So another thing is there that even though you're a stockholder and you are essentially an owner in the company, there is no requirement to repay your investment. So you get in the company, you put $1,000 in, and the company goes belly up, you've lost $1,000. It's very difficult for stockholders, shareholders, to show malfeasance. Now, I'm not going to say it's not done. It's very difficult to do that. So most stockholders don't. Remember also down here, this last thing. If we issue, if we issue more stock, that can improve the balance sheet because issuing stock doesn't create any extra debt. Now, what it does do is it can, if there's like a 2-for-1 split, like I talked about before, it dilutes the value of the shares of stock. So if you had shares in a company and you had 100 shares and they're worth $10 a share, and the stock split 2-for-1, you now have 200 shares and they're worth $5 a share. Now, I want to give you a little caveat here that when the stock splits, it doesn't always actually half what you have. Sometimes it's a little more, sometimes it's a little less, but normally speaking, it's half the value. So you still have the same amount of monetary value, but your individual shares are not worth as much. Now, what are the disadvantages of issuing stock, especially if you do a stock split or you issue stock that people can buy? You run the risk of lowering or reducing company ownership. And remember that stockholders, especially common stockholders, have the right to vote for the board of directors. I'll come to that in a second. I sort of took the second bullet, put it first. Issue too many shares of stock, then you're going to alter the ownership of the company, or you're going to perhaps increase a minority stockholders' number of voting shares, maybe not to overtake the ownership of the company, but to a significant portion of the company, where that person is going to ask for a right to name somebody for a seat on the board of directors, etc. Dividends are paid after all the other expenses, including taxes, are paid. You don't pay dividends ahead of time, so there's no way you can make a deduction on that. And obviously, you have to keep the stockholders happy, and that can cause problems for management. It was for a long period of time common when a company would send out an annual report and say we're going to hold voting for seats on the board of directors and for a couple of other type things like various and sundry issues that we have before the stockholders. And the company would say, we want you to vote for all these folks on the board of directors, and we want you to vote in favor of all of these amendments, or we want you to vote against all these amendments. And people would dutifully do exactly what the company wants them to do. Now, that's not quite the case today. And I won't give you necessarily an individual perspective. We do get to vote on those, my wife and I do, on an annual basis. But investors are becoming more and more rebellious in a way and saying, no, we're not going to do this, or we're not going to do that. We're not going to vote for what the company wants. Unfortunately, even when directors have not received the number of votes they're supposed to receive to be retained on the board, companies have been reluctant to remove them. I think that's going to change, but I don't think it's going to change anytime soon. Now, these are the two classes of stock, common stock and the preferred stock. And see what the common stock folks have the right to do, board of directors, and share in profits if dividends are approved. The preferred stockholders are exactly in a way what they say. Excuse me, I need to go back here. Need to come down just a little bit. I think there we go. They're given preferences in payment of dividends before the common stockholders do. And they can also the preferred stock can be callable, it can be convertible, or it can be cumulative. Now, none of those options are available to common stockholders. So sometimes you'll see two classes of stock, well, sometimes you see two classes of stock and it doesn't come down to preferred and common. But normally speaking, it does come down to this, and everybody doesn't get into preferred. More and more people, or more and more shares of stock are held as common stock. Now let's look at the language of bonds. Remember, we did a little bit of this last week. We're kind of coming upon it again, a bond is a certificate that's given to an investor that he or she has lent money. Now, these people are not investors in a traditional sense of the word, because most investors are putting money in and expecting a return. Bond people are expecting a return too, but they've lent money. When I buy stock, I'm not actually lending money in the terms that we normally think of lending money. What's the reason for me saying that? There is nothing that says my investment's going to be returned to me. The difference with a bond is it's a contract. Say a certificate, if you want, however you want to put that, where I, the borrower, and that's exactly what I'm doing, I'm borrowing money, and this person is lending me money. We can consider him an investor if you want to think about it, but it's a little bit different. And I have to pay that person back the principal, which is the face value of the bond, let's say $1,000. And then if I'm holding the bond for, since it's $1,000, we'll make it too long, for 2 years. I have to pay that person interest at a specified time at a specified rate, which is in the contract. If I invest in stock, none of that is applicable. None. They don't have to pay. Remember, they don't have to pay me dividends, and they don't have to pay me my investment back. Bondholders have to be paid back. That's a law. And they have to be paid interest when the interest is due. So you're looking down here. Bondholder to compensate them for the use of their money. So that's what a bank does. You have a savings account or certificate of deposit at a bank. The bank pays you for the use of your money in the term of interest. And we know that the interest rate paid today is very low. It's supposed to go up a little bit, but probably not going to go up very much. But we need to think differently about bond investors as opposed to stock investors. Different animals. Now, this is some here about bonds, which we can see graphically displayed in the text on page 540, figure 19.2. These are government bonds. Government bond, then a treasury bill, treasury note, then a treasury bond, in the municipal bonds, and the Yankee bond, which I'll come down to here just a little bit. So many of us may not be really familiar with the Yankee bond, and notice it's issued by a foreign government, but it's paid in US dollars. All right. So what are the advantages of bonds? Well, even though we've used the term investor, we need to look at this bond person, the person who has bought the bond, as a creditor, because you have to pay him or her back. They're not owners in the firm, and they can't tell you how to run the firm. Now, if you remember last week, I think we said that there may be some provision in the bond contract, if you will, that allows that, but that's very, very rare. The interest we paid can be taken off taxes. They're a temporary source of funding, and they have to be repaid. I don't necessarily consider that an advantage, but some people do. And remember that bonds can be repaid before the maturity date if they're known as callable bonds. Now, these are the bond ratings. There are 3 major rating agencies in the United States: Moody's, Standard & Poor's, and Fitch. One of the issues that has come up about these rating agencies is that In some cases, they gave some firms, especially in the securities business, banks, etc., pretty high ratings before the recession. And there have been some issue about this. Unfortunately, it's gotten into a political dogfight, I think, and I really don't think we'll see any of these rating agencies held to task. But you have to be careful here because rating agencies actually work for the companies they rate. And so in some cases, you're not getting the independence that you would like. Now here we have, we want to speak here about the different classes of bonds, or different classes of corporate bonds, if you will. Unsecured bond it's not backed by anything. Normally speaking, a bond is backed by some type of collateral, often by real estate. And then a secured bond is just the reverse. And there is what it has to say about that. I don't need to repeat that. Oh, all right, here we go. Now some issues here. We have something that's known as a sinking fund. I want to read this because it's not always easy to grasp this concept. I'm not trying to demean anybody, but sometimes we don't grasp it right away. Reserve account set up to ensure that enough money will be available to repay the bondholders on the maturity date. It could be called something else. It could be called could simply be called a reserve fund. It's not. It's called a sinking fund, and that's why I want you to see that. We talked about callable bonds before. We don't need to repeat that. But the value to that is that they can be repaid before the maturity date. And of course, that's going to save the borrower money. And then a convertible bond allows the investor, the creditor, to convert their shares into common stock. Okay, now we've talked about these things, these securities, stocks and bonds. How do we buy them? Well, we kind of talked a little bit about this before. And that is, you have to go through a registered broker, or representative is said here. And this person works as an intermediary. Remember, we talked about intermediaries back in chapter 15 in a different context, but it's the same principle here. And this person is allowed to buy and sell, buy and sell securities on behalf of his or her clients. Usually this stockbroker works for a company that is in the stock brokerage business or in the securities business. Many people go through mutual funds, some go through EFTs, or ETFs, electronically traded funds. Here's some online trading services. These are for people, services online to buy and sell stocks. So you don't have to go through somebody else. This is a ethical decision. You can find us on page 543. I'm not going to go into that, but as always, I do suggest that you read it. These are investment criteria that everyone should ask him or herself before they get into buying any type of security. What's the risk? How much am I going to get back for my risk? How long do I have to hold this? What's its liquidity? That means how quickly could I turn the security into cash? And what are the tax consequences? You need to ask usually to someone who's in the tax business, give you some kind of an idea. The normal rule of thumb is that the younger you are, the more tolerance for risk you'll have. And I think that tends to be true. My wife and I own a mutual fund which probably has a fairly moderate to high level of risk. I wouldn't be interested in buying that today at my age because I don't want to get into that risk. I'm more interested in being able to get my money and turn it into, get my security back and turn it into some kind of liquid for myself, cash. But you need to ask every one of those questions to yourself and maybe bounce it off somebody that you trust before you buy any type of security. One of the things that well, let's go back to investing 101. These are things that you can do. Take an investing class, go to a conference, go to the public library. Often the public library will host these types of classes, and they have a lot of books there. You're going to do the video on Morningstar, and Morningstar also has these things available online. So something you can take advantage of. I don't know the cost of those. Some of them may be free, and of course that's something that you want to look for. This slide just gives you the different asset classes and the average annual rate of return for them since 1926. Now remember, this takes into consideration the Great Depression, which started in 1929 and lasted for a good part of the 1930s. Small company stocks have normally outperformed large company stocks and corporate bonds by significant margins. There's a greater risk in small company stocks. And then by a huge margin over Treasury bills. Okay, now why we want to put Treasury bills on? Treasury bills are considered to be safe, sound investments, which will pay a reasonable, my word, a rate of return, but not stellar. Stellar being 12%. And so this is what they've done, but the average market return has not been that high, 12%, since 1926. Doesn't mean to say that some people haven't made that return. They have, but the average stock market return since 1926 has probably been around 9%. It might be a little bit lower. It's not as high as 10%. At least it wasn't last time I looked. This just talks about diversification. Simply put, don't put all your eggs in one basket. I know that's an old adage, but it holds true here for investing. Before you invest anything, you need to understand what your long-term and short-term goals are, and then invest accordingly. Get some sound advice about investing. Use Morningstar or the library or some other type of resource, and then put your money in things that you think are going to give you the return that you want over a specified period of years. So, you just have to be careful about how you do this. Global stocks may be in your future, but what I would tell you before doing anything about global stocks, as well as doing anything about any investing, is do your homework first. Find out what the volatility is. Find out what the rate of return is. Find out how durable these stocks are. How well have they done over a period of time? If you get into the stock market, get into the stock market to buy and hold. You can't get into the stock market and be in and out. Now, if you're a large investor, if you have megabucks, yeah, you can do that. But most of us don't have that. So think about getting in and holding your stock for a while. This is based on consumer needs here. These are the things that you need. You need advice. You may need help with 401k plans. I'll come back to that in a second. Think about retiring. If you're in your 20s, you don't think about getting old, but you need to make those plans. It's harder for a 20-year-old to do that, or 20-some-odd-year-old to do that, than somebody that's 40. But the person who's in his 40s probably should have been investing back when he or she was in the 20s. And there's some other things on here. 401k plans, the only thing I want to tell you about them is I believe in 401k plans. I think you should invest in them, but do not do all your investing in the company stock. That's just a recipe for disaster. And you can ask anybody who worked for Enron and invested in its stock in its 401k plans, and they can give you more convincing argument than I can. Two perceptions of the market, bears and bulls. Bulls kind of think the market's going to continue to go up. Bears are just the reverse. Some people are saying we're entering a bear market now. There are some signs. The NASDAQ probably is in bear market territory. Neither the New York Stock Exchange nor the Standard & Poor's 500 are in that, New York Stock, Dow Jones, excuse me, are in that territory. I think we're probably in for an uneven year. I thought we were going to be in for an uneven year last year, and it was actually until September, maybe October, it was pretty decent. We did have that blip in August, but it's kind of panned out in the fourth quarter. I want to say I was pressing. I just thought it was time for correction. I'm not going to try to make any predictions this year other than the fact that I think it's going to be uneven. This slide just gives you some bear market periods in the Standard & Poor's index since 1987, drop in prices, and I only put that up there to show you information and not to scare anybody. Capital gains, this is a difference between what you bought the stock for and what you sell it for, and that is taxable. And you can also look at shares, for buying shares for blue chip stocks, growth, income, and penny stocks. Pardon me. Penny stocks have a lot of volatility to them, but they don't cost a lot. We talked about stock splits before, and I'm not going to spend a lot of time on it, except notice that it doesn't cause any change in ownership and no change in the value. And firms are never required to split stock. This is risky, buying shares on the margin. And the reason it's risky is because if the broker, third bullet, if the broker issues the margin call, you have to come up with the money to cover your losses. This is what happened in 1929. A lot of people bought on the margin, and when the panic started, I don't remember what actually started the particular panic, or what particular thing started the panic. People are unable to pay the margin, and so we really have to be careful about that. Try not to buy on the margin. Now, understanding stock quotations, you can see this graphically displayed a little bit better in your text. Down at the bottom of page 547, figure 19.4. It's pretty self-explanatory. These are the top research sites for financial news. I'm not going to go over that. Questions to ask about bonds. Do you have to hold a bond until maturity date? No, you don't have to, but you won't get all your money back if you don't. And then how can I assess investment risk of a particular bond? Again, you have to do some research here, and you have to look at it and adjust accordingly. Junk bonds are exactly what they say. They have a lot of volatility. They can give you a great return, or you can lose money. And these are quotations for bonds. and gives you the price. A coupon is how much it's paying percent-wise, what the maturity date is, yield, current yield, what Fitch rates them for, et cetera, et cetera. These are two ways to invest that really help people in mutual funds, which I talked a little bit about before. You actually are paying money into an organization to buy shares in a particular fund. That fund is usually a group of stocks. There could be some bonds mixed in there, and they will buy for you. And the object is that there's a lot of people in this, and you're kind of all sharing the pain or the good times together. It takes the individuality out of it, but it also gives you a little bit of peace because there are more people in with you at the same time. Exchange traded funds, similar collections of stocks and bonds traded on securities markets or on securities exchanges, but they're traded more like individual stocks, which is different than a mutual fund. Mutual fund is not traded like individual stocks. This is just talking here about some mutual funds can learn, reform the rating system, give out free information, be transparent, share insights. Really talking about communication here more than anything else. That's a percentage of households owning mutual funds, gone from 5% in 1980 to almost 50% in 2010. That's the last figure we have here. So understand there. Mutual fund quotations. And this is something that you can see again in your text on page 551 at the top. And it's pretty self-explanatory here again, what you're being able to do. Comparing investments now, this is also seen in your text in the middle of page 551, figure 19.8. Type of investment on the left, degree of risk, expected income, and possible growth or capital gain. And I'm not going to go over that. You can see it much better in the text, and it's pretty self-explanatory. So I'm not going to spend any time on that. Dow Jones Industrial Average. Again, I said it's a very narrow market. There's 30 in it right now. The 30 are listed on the right. The original 12 are listed on the left. General Electric is the only one I think that's still on there that was on the original back many years ago. You can check me out to see if I'm right about that. But again, it's only 30 stocks, and it's most widely used because it's easy to calculate. But again, it's not the most accurate. And this gives you a little more information about the Dow Jones. Too small compared, 30 is a lot smaller when compared to 500. And so it's just a lot different. We know what market turmoil is. We've had it. There's some dates to remember, and we don't need to spend a lot more time on that. And we, of course, we've had turmoil in the 2000s. We had the dot-com bubble, and then we had the financial crisis of 2008, starting actually 2007. And this is the Wall Street of now, then, and what we're doing now. This is a thing that causes us a lot of issues here. And that's what I talked about before with CalPERS. And this is program trading. And CalPERS is not the only one that does this, by the way. But what program trading simply says is that the program in the computer says when the price reaches X, we're going to sell. When the price reaches X, we're going to buy. And that moves the market quickly, and probably moves the market faster than I can say the word quickly. And this tells you what happened in 1987. I believe that folks believe that's happened. Question here is, who's at fault for the economic crisis? Probably more Wall Street than anybody else. I'm not going to try to lay blame somewhere, but they're the ones that came out with some of these risky investments. You'll find the folks on Main Street simply don't do that. They live too close to their neighbors, and they're not going to get into issues about doing things of that nature. These are some of the provisions in the Dodd-Frank bill, which, of course, as I've mentioned before, we go between the, see this at the top of page 555, we go between the yin and yang of let's let the markets do what the markets want to do, and now wait a minute, we have to have some regulation here. We need both. We need markets to be free, but they need to be regulated. And the other thing that we need to do is we need to hold people accountable. The government has fined some of these large banks mega dollars, but no one person has been held accountable. And you know, that's just not right. And there's a lot of people that are fired up about that. I'm not advocating this, but if you listen to Bernie Sanders' campaign, that's what he's saying, part of what he's saying. Other people are taking a different approach to that, and I'm not going to name any names because I don't remember anybody off the bat. But our jurisprudence system says we hold people accountable on institutions, and yet we don't do that. And we've done it in some cases, but there have been some issues, and the government, and unfortunately, has not been able to prove government and governments. State and the federal have not been able to prove their cases for various and sundry reasons. And some people who probably have been the generators of these specious investment instruments have kind of walked free. Their companies paid, but they haven't. That's enough of my soapbox. It's 5:26. Will be a little shorter in the next go around because chapter 20 is shorter than chapter 19. Please come back at 5:30. Thank you. Please come back at 5:30. All right, it's 5:30. We're back. Chapter 20, Money, Financial Institutions, and the Federal Reserve. And let's look at our learning objectives for Chapter 20. Explain what money is and what makes money useful. Describe how the Federal Reserve controls the money supply. Trace the history of banking in the Federal Reserve System. Classify the various institutions in the U.S. banking system. And briefly trace the causes of the banking crisis and explain how the government protects your funds during such crises. Describe how technology makes banking more efficient, and finally evaluate the role and importance of international banking, such as the World Bank and the International Monetary Fund. But question here is, what's money? Well, it basically is, as the definition says, it's anything that people accept for the payment of goods and services. For instance, in the 1600s in Holland, you could use tulip bulbs to buy things, and people's wealth was measured in the number of tulip bulbs that they held. Well, after a period of time, that came to a crashing halt, and the tulip bulbs were no longer around. Barter is much different. It is trading goods and services for other goods and services which may not be of equal value. Now, I'll give you the best example of that I can remember when I taught a different class in a face-to-face setting. This came up, and I asked students about barter, and there was a woman in there came up with a very good definition of barter. She had some furniture she needed to move. I don't know whether she was moving to a new house or a new apartment or what. And she knew this gentleman that had a truck, and she said, if you'll help me load the furniture on your truck and move it from place X to place Y, I'll cook you a chicken dinner. And they struck a deal, a barter. No money traded hands. Now, who got the better of the deal? I don't know. Both people got something they wanted. These are the useful forms of money, and money has to fit each of these characteristics. Actually, what this says, and you don't see the top part of the slide, is said, and I apologize for that. It's standards for a useful form of money. And I prefer to use the word characteristics. It has to be portable, it has to be divisible, stable. It means that obviously you have to have a functioning government, and people have to have faith in it. Has to be durable, last for a while, and then it has to be unique. So, if you go to England, for instance, you'll see that they have paper currency over there, like we have here with the $100 bill with Ben Franklin's picture on it. Ben Franklin's image probably is a better way of saying that. Well, if you go to England or other places in the United Kingdom, which would be Scotland for right now and Northern Ireland, you would find paper money with images of the Queen on it. And there may be some other ones. I don't remember. I haven't been to England in about 10 years. So there may be some difference. But one of the differences they probably have more coins than we do, because you can have a pound that's a coin. And we had some coins for a while that just didn't work. People didn't want to use them. Coins at that denomination, about $1. Of course, a pound is worth more than $1. Now, we're going to talk here about Bitcoin, and I want to tell you that I am pretty close to being ignorant about Bitcoin and how it works. It's a digital currency. Now, a lot of people think that currency as we know it today is going to go away. I happened to see a piece on 60 Minutes some time ago. I'm not a big 60-minute watcher, but my wife is, and talking about people using a digital currency in Kenya. And people had their smartphones and they'd say this and that, something else. Notice that the attraction here, there is no central regulating authority. And most of us humans have a great aversion to regulations and regulating authority. We Americans decided we weren't going to put up with it. We started a Revolutionary War because we didn't want to pay attention to the regulations that the British put on us. Notice that there are transactions between two people, no middleman. And what is the bottom point? It's very difficult to calculate the value of Bitcoin. Now, I throw something out to you. If any of you have some kind of an idea a little bit more about Bitcoin than I do, please share it with, not just with me, but with your fellow classmates. I really don't know a whole lot about Bitcoin. I'd be the first to mention that. But I have to tell you, I'm suspicious of it, and not because I'm a person that likes regulation, but I think you do need to have some rules, and there don't seem to be any here, and so it bothers me. I see the potential for a lot of fraud. All right, now before we get to talking about the Federal Reserve itself, who actually manages this, we're going to talk about the money supply. Three kinds of money. We classify money in three ways: M1, M2, and M3. So think of M1 money as something that you can, if you had it, you could go get it right away. Coins, etc. And traveler's checks fall into that because they can be turned, pardon me, they're negotiable instruments that can be turned into cash immediately. M2 is everything that's in M1, plus those things that you have money in certain investment areas, mostly with banks or savings and loans or credit unions, that you can get to, but it's going to take you a little bit of time. Now, what do I mean by a little bit of time? It might take you a day, might take you, something less than a day, an hour or two, but something like that. And then notice also mutual funds fall into this. Besides savings accounts, CDs would be in that area as well. And then M3 is everything in M2 plus big deposits like institutional money market funds. This is just a gee whiz slide talking about money that was printed in billions of dollars. And this talks about how long paper money lasts. I'm not going to go into that a whole lot, but it's interesting to note that a dollar bill lasts longer than a 5 or a 10, and almost as long as a 20. And then 50 and hundreds last longer, and reason is because they're not used as much. There are some milestones. Congress set the minimum wage at $1 in 1956. And then some other things we go through here. $1 billion stadium built in London at Wembley Stadium. A lot of soccer matches are played there, or as they would refer to it, football. There's some more money facts that I'm not going to go into. Now, this particular slide talks about exchanging money globally. And falling dollar, rising dollar. What makes the dollar fall and rise is the position of the U.S. economy relative to other global economies. And as we know today, our dollar, the Yankee dollar or the greenback, whatever you want to call it, is doing very well against other global currencies. There's some real pluses and minuses to that. That means if we travel outside the United States, our dollar is going to buy more. Conversely, it takes more for those countries, people in those countries, to buy American-made products. So that's a downfall to our folks who are trying to export their goods. Which we see that some of the companies that we know, pardon me, some of the big companies we know are struggling a little bit. They're not actually losing profit, but they're not making as much profit because the dollar is stronger against the European and Japanese and Chinese currencies, and so people aren't able to buy as much. People living in those countries. Now, if we have a falling dollar, that simply means that the dollar is worth less. Worth less, not worthless. It'd be more people buying more American-made products, as we talked about before. Favorable exchange rate for our companies exporting overseas, and tourism into this country increases because the foreign currency is worth more than the local currency. Now, I'll just give you an example of currency values. The last time that my wife and I were in Europe was, I think, 3 years ago. Oh, no, excuse me, it's a little bit longer ago than that. Anyway, and maybe it wasn't. I'm losing my train of thought. No, it wasn't. It was, yeah, 3 years ago. The dollar against the euro was trading at about $1.35 or more. In other words, it cost me $1.35 to buy 1 euro. That actually was a little bit higher, $1.37, $1.38. Well, yeah, as of Friday, the last day of trading, American markets are closed today in observance of President's Day. American dollar was trading at about 1.12 to the euro. Now, it's actually been a little bit better. I've been down to about $1.06 or $1.05, but the euro has rebounded a little bit. So that, that's 20 some odd cents difference. A huge difference. Now, this is the 5 major parts of the Federal Reserve System. We have the Board of Governors, the Federal Open Market Committee, that's the ones that set the rates. We have 12 Federal Reserve banks, 3 advisory councils, and the member banks of the system. You can see a graphic display. Well, it's right here on this slide, and you might be able to see a little bit better in your text figure 20.1 on page 571, which gives you the 12 regions in the United States. Now, this particular thing next comes to you, and you can see this in your text, this is how the Federal Reserve controls the money supply. And you see the reserve requirement. This, by the way, this is figure 20.2 in your text, right below the map. You have 3 things there that impact the money supply: the reserve requirement, the open market operations, and managing the discount rate. So if let's go to the reserve requirement. If the Fed makes the banks put more money into the Fed, that way the money supply is tightened, the economy will slow. If it does the reverse, the economy speeds up. And you can read these all the way down. Selling bonds, buying bonds. That's what we did in this quantitative easing thing. That's what the Federal Reserve did to keep the economy moving when it hit its nadir back there in sometime in 2008. And then managing the discount rate, increasing the rate slows, decreasing the rate speeds up. I'm not going to go through this next slide a whole lot for you. This just shows how the Federal Reserve clears checks. And we find out that not too long ago that the Federal Reserve has eliminated some of its check clearing operations in the United States. Why? Because people are paying their bills electronically. So they don't need to have as many check clearing things. My wife and I still pay some things by check, but the vast majority of the bills we pay is done electronically. And please don't ask me how we do that, because my wife takes care of it and she doesn't let me get near it. And that's not meant to be smart aleck, that's meant to be a statement of fact. The Federal Reserve was created in 1907 as a cash shortage problem came. And you might be interested to know, I don't have this exactly right, but J.P. Morgan, J. Pierpont Morgan, told the President of the United States, Theodore Roosevelt, I can put up X number of dollars, 25 million sticks in my mind, and we'll stem this tide. And Roosevelt did not want to do that because he didn't want to be beholden to one particular person. Now, notice here that in the Federal Reserve Act of 1913, all federally chartered banks, federally chartered, you have to think about this now, because they're federally chartered banks and they're state chartered banks, and they're different, had to join the Federal Reserve. When I was in the Army some years ago, I was at a school in Texas, and most of the banks in Texas at that time were state chartered. And so I had some travel pay coming to me not too long after I got there. And I didn't want the money laying around, and I didn't want to send it home. Not that my wife needed the money or did need the money. It just wasn't something I wanted to do or was comfortable with. I was going to be home for a while. So at the advice of a number of people, said, well, you ought to go to a bank and open up a bank account just in case. So I had this money, a check, and I'll go do that. Well, if I wanted to do any business with that bank, and I don't even remember the name of it, I had to go back to that particular branch. I couldn't go to one of the other branches of the bank. And that was the difference between being federally chartered and state chartered. I never went back to the bank until it was time for me to get my money out. Of course, I made a little bit of interest on it. I'm not going to spend a lot of time on this, but this shows us the largest bank failures in the United States, and the cost, in many cases to us, the taxpayers. We have commercial banks, savings and loans, credit unions, and non-banks that are in the banking business. Commercial bank is the one that most of us are most familiar with. They're in business to make a profit. And they take in money in the form of deposits from people like you and me, and of course from institutions. And then they have things like checking accounts and savings accounts, and they use the money in those accounts to issue loans, or make loans, as it says here. Two types of customers, regardless of your walk of life, whether you're private, institutional, or whatever. The two are, you're either a borrower or you're a depositor. Now, of course, you can be both. For instance, a bank that holds our mortgage, we also are a depositor at that bank. So we borrowed money, we pay them the mortgage, and they hold that mortgage. And like everybody else would pay our mortgage once a month. We also are a depositor. These are the services of commercial banks. Demand deposit. Notice that that's the technical name for a checking account, because that money has to be available when the depositor wants it. Time deposit also, well, I was going to say something that's not right, so let me stop. Time deposit is a savings account, and the bank can say, well, okay, we'll give you X amount of this today, and you come back and get the rest of it tomorrow. Or, as it says here, you have to tell them ahead of time when you want that money. And a certificate of deposit is like a savings account, earns interest, and that interest is to be given to you at the time that the certificate matures. Now, normally speaking, pardon me, your certificate earns interest depending upon how the bank pays it. It could be paid monthly, it could be paid quarterly. And so if it's a year and you're going to earn 5% on that, that 5% is paid after the year, or at the year maturity date, and you go get your $1,000 back plus 5% interest. Some compounded, so it comes a little bit higher than 5%. However, if you take that, if you need to terminate the certificate of deposit early, you forfeit some amount of your interest. I can't tell you what the percentage of interest is, but you will forfeit some percent of it. You'll get your $1,000 back, but you won't get that entire 5%. This is what would you tell the teller, making an ethical decision, that you could see on top of page 577. Again, it's not something that's required for you to do, but I always suggest that you read those, because they're interesting to read and gives you some kind of insight into making ethical decisions. Savings and loans are similar to banks. Both they have both savings and checking accounts and provide home loans. That was the original intention of the savings and loan associations. It was to take in deposits and to make home loans, known as a thrift institution, because that's what they were supposed to do. They were supposed to promote thrift. Savings and loans have gotten into a lot of other areas of the banking industry, or the banking business, I should say, than they were originally intended to do. My uncle was an officer of a savings and loan firm for many, many, many years, and I grew up with that. We were taught to have an account there and save, etc. And the only thing you could do there at that savings and loan was to put money into accounts, save money, and to have a mortgage. My family and I did both for a number of years. We no longer bank with them or have money with them, not for any particular reason, but we did both. We had our first mortgage with them, and we had savings accounts with them and certificates of deposit. But they didn't have checking accounts in those days and things of that nature. A credit union is similar to a bank, but notice that it's member-owned. It's considered a cooperative, and they offer a full range of banking service. They're nonprofit organizations, and notice that they enjoy exemptions from federal income taxes. Then we have non-banks. Many insurance companies are in this business. Walmart tried to move into the business. I'm not sure whether they were successful or not. There was some concern about that, and that maybe I'm not sure where that is today. It's not something I've followed, and I apologize for not being able to give you more information. Taking a bite out of the sharks. This is a spotlight on small business, and that's something you can read at the top of page 579. Online banking. wave of the future, and you know that's probably going to change if we go to this Bitcoin business. I don't know where banks are going to go. There's a lot of mistrust for banks, especially large banks, not so much on Main Street, but certainly those that deal with Wall Street. This is what online banking can do for you. Identity theft protection, personal financial management, etc. Well, we know about the banking crisis. A lot of people suffered here, and banks suffered as well, but some of it was due to their malfeasance. And we really can't assign blame to either just the government or just the banks and other financial institutions. There's probably plenty of blame to go around. We have the FDIC, the SAIF, and then the NCUA for Federal Deposit Insurance Corporation, Savings Association, Insurance Fund, and the National Credit Union Administration, where accounts are insured up to, by the federal government, up to $250,000. Electronic funds transferring can be done the same way as similar to a debit card, and some things that you may want to do. There usually is somewhat of a charge for electronic funds transfer, so you want to make sure that you check that before you for something that you do. Smart card, we know what that is, combination of a credit card, debit card, phone card, etc. And some things that you may want to do, you may not want to. These are things we can do with making transactions outside the United States. Letter of credit. The bank is promising to pay the seller a given amount if conditions are met. Banker's acceptance. Promise the bank will pay some specified amount at a particular time. And then money exchange allows companies to go through a bank and exchange currencies to use in a particular country. So something that is probably interesting to you. World Bank lends most of the money to less developed countries to improve their productivity. And then the International Monetary Fund fosters cooperation of money. Fosters cooperative monetary policies that stabilize the exchange rates from country to country. And this is the new day, new issues across the globe. International Monetary Fund and World Bank are trying to come up with answers to global issues. We have a new director of the International Monetary Fund, a French woman by the name of Christine Lagarde. A financial crisis did lasting harm to potential pace of growth into something we have to be concerned about on an everyday basis, but it seems to be something that we just don't pay attention to enough, and we tend to relive our problems instead of trying to solve them. That brings us to the end of chapter 20. As I mentioned, it was a rather short chapter. We will be back next week for another short lecture. We will cover 3 of the bonus chapters. We'll cover bonus chapter A, bonus chapter B, bonus chapter C, and bonus chapter D. The lecture question for tonight is, what are the 3 ways how the Federal Reserve controls the money supply, and show the advantages and disadvantages of using a particular one of those one of those methods to control the money supply. So again, what are the three ways the Federal Reserve controls the money supply, and what are the advantages and disadvantages of each of those methods? So I thank you for your attention, and I look forward to speaking with you again next week. Thank you, and good night.